Busy commercial kitchens create unavoidable physical risks. Staff pivot around tight corners, hot trays move at high speed, and wet floors are a constant operational reality. Most business owners looking at these three different quotes start with a single goal: identifying the one with the lowest price. This makes sense for a consumer, and the $800 option is the natural target. But business insurance is a complex legal contract rather than a basic commodity. It dictates the exact level of financial support you receive, or don't receive, during a crisis. Prioritizing the lowest monthly premium often results in a financial shortfall that exceeds the total lifetime savings of the policy after just one significant claim. To find the actual value of these quotes, we have to analyze the specific factors beneath the price tag that determine your actual protection. Choosing the cheapest policy shifts the burden of unmitigated financial risk directly onto the business owner. We begin with the absolute ceiling of your financial protection. Coverage limits represent the maximum dollar amount the insurance company is legally obligated to pay for a covered claim. Here, we see a $1 million limit next to a much taller $2 million limit, which requires a slightly higher monthly fee. If a liability claim hits $1.5 million, the cheaper policy leaves you with a $500,000 gap. The more expensive policy absorbs the entire blow. That extra monthly capital prevents your business from facing total liquidation during a severe event. Your coverage limits define the mathematical difference between surviving a difficult quarter and closing your doors permanently. The next variable is the immediate out-of-pocket cost required to activate your insurance during an emergency. This $10,000 block represents the deductible. It is the financial barrier your business must pay before any insurance funds are released. Selecting a massive deductible lowers your monthly premium, saving $500 a year. However, this requires massive liquid cash reserves. If you have an $8,000 loss, the insurance company pays nothing because it doesn't clear that $10,000 wall. Lowering the premium this way turns minor to moderate property damage events into functionally uninsured losses. When heavy inventory suddenly collapses and significantly damages your facility, the massive repair bills are due immediately out of your own pocket. Selecting a high deductible transfers the cost of common operational hazards directly back to your own cash flow. We then have to evaluate the specific fine print found in the back pages of the policy. Exclusions are specific threat scenarios removed from the policy's protection. Here, the red marks show that cyber attacks and specific water damage are not covered. A low-cost policy often achieves its price by leaving high-probability threats like these missing from the coverage. This leaves the business owner vulnerable to the most common modern risks. If a ransomware attack freezes your operations, a cheap policy with a cyber exclusion means the insurer will legally deny your claim. Beyond the document itself, you must consider the operational reputation of the company. Established legacy insurers with strong physical claims handling infrastructure operate differently than cheap algorithmic pricing apps. Paying a premium surcharge for a highly rated carrier guarantees rapid response times and fair payouts during a crisis. A cheap premium paired with catastrophic exclusions and a weak insurer creates a 100% loss on your investment when a disaster occurs. Evaluating these trade-offs requires a systematic approach based on your specific stage of business. The Policy Optimizer flowchart helps you map out your ideal configuration. It begins by looking at your current cash flow. For a budget-conscious beginner with very tight cash flow, the path leads to a specific combination. You accept higher deductibles to manage monthly costs, but you never sacrifice the high coverage limits that prevent total bankruptcy. An established owner with healthy cash flow takes a different route to protect their assets. They spend extra monthly capital to remove exclusions and add protection for high-probability threats like business interruption. A good deal looks different depending on your scale and cash reserves. A properly structured, comprehensive insurance policy holds firm when heavy, unexpected stress is suddenly applied to your growing business. Prioritize the configuration that guarantees your business survives its worst-case scenario over the one with the lowest upfront cost.